A popular investment strategy on Wall Street is buying high dividend yield stocks. But does this strategy actually work? Historically, mostly no. We're going to test this theory over 5, 10, 20, and a 30-year time period. And what we'll find is high dividend yield stocks actually underperform in all instances. I'm also going to show you how and why this is the case. Here's how the 5-year test works. We'll compare three strategies against high dividend stocks. Our first strategy is obviously our high dividend stocks. These companies were found to be the top dividend paying companies in 2021, paying between 2 to 6% dividend. Next, we have a low dividend yield stocks paying between 0.1 and 0.9% dividend. We also have stocks that pay no dividend, and for a benchmark comparison, we will finally compare against an S&P 500 ETF. In all instances, we'll be making a once-off purchase of $200 equally split between all stocks, while for the S&P 500 index, because it's only one, so the full $200 will be in the SPY. In all instances, we are choosing our stocks from the top 50 S&P 500 companies at the time. Now let's get into it. Starting the 5-year test, the highest yield dividend stocks are in the lead, but is quickly overtaken by the low yields by about mid 2023. Now let's do a deeper dive. We'll notice Exxon is pretty much carrying most of the performance for the high yielding stocks, just coming out of the bull market of the COVID crash where oil prices were finally recovering. Exxon saw a fantastic boost with huge investor confidence, but for the low yield scenario, we quickly noticed that Nvidia is a key driver to the low yield strategy, with its value far exceeding any stock from any strategy, as you can see. I think to be fair to the high yield here, if we didn't count Nvidia, it would probably be in the lead, and actually, as you will see in the next test, this is the only test high dividends fared okay. Let's move into the 10-year test. Like our first test, we are comparing the same three strategies against our high dividend strategy. Again, we invest the same amount across all strategies. But note, the only companies in 2016 that were in the top 50 S&P 500 that didn't pay dividends were these. So we have split the 200 across the four stocks. Starting the 10-year test, high yield is on the back foot from the get-go. And by the time we get to June 2026, it has been well and truly outpaced by all strategies. Let's do a deep dive. At the start of 2016, Nvidia was not quite part of the S&P 500 top 50. So this is a great chance to see how low yield go without this overperformer in the mix. We see lowest dividend is carried by Apple and Costco to a large extent, but even if we remove these two stocks from the result and left the remaining 8 stocks, low yield would still be in the lead. Same with no dividend. Even if we remove Google completely from the mix, the 3 remaining, when added together, would still outperform the high yield strategy. Now let's move to a longer time frame, the 20-year test. Note again that the only companies in 2006 that were in the top 50 S&P 500 that didn't pay a dividend were these. So we have split the 200 across the 6. Moving into the actual 20-year test commencing in 2006, the high yield stocks do decently well for about a year and a half, loses a bit of ground during the GFC with Bank of America and Citigroup taking a hit with their presence in the finance and banking sector, then loses significant ground from about 2018, and again finishing the worst performer by the time we get to 2026. When I initially saw this, I did think it was potentially unfair against the high yield, as the early 2020s brought about a huge surge in AI, semiconductor, and tech stocks. But when we look at the deep dive, we will find this is not the case. Interestingly, we find performers in the low yield stocks, Costco and Lowe's, are not tech companies at all. They are bricks and mortar retail companies. Even for no dividend, if we deducted Amazon and Alphabet, it would still be marginally ahead of high yield. And we also have the S&P 500 index crushing high yield by about 50%. Now let's go into the finale, the 30-year review. Within about a year, the high dividend again falls right to the bottom. Coming out of the dot-com crash, it gains decent momentum going into a steady bull run and actually manages to get ahead of the low dividend and S&P index, albeit still well under the no dividend option. But going into the mid 2010s, high dividend strategy takes a turn and steadily loses ground to first the low dividend strategy and then also the S&P index. As we get through the COVID period and head into 2026, we see yet again the high dividend strategy is trailing the rest, and by quite some margin. When we take another in-depth look, we see the lowest dividend yield is again mainly dominated by non-tech companies like Lowe's, United Health, Home Depot, and Walmart, dwarfing IBM and Intel, showing us that this performance with the low yield stocks is not simply just due to an extra boost from low dividend tech companies. In all four tests spanning 5, 10, 20, and 30 years, high dividend stocks have underperformed low dividend stocks. And crucially, in the 10, 20, and 30-year test, it was actually the worst performer. Why? Let me simplify it for you. Let's say you and I own an Italian restaurant. That means the business is owned by two people, and so we will assume any profit is either split or reinvested. If we were to take 50% of our profits each year, that would only leave 50% to reinvest back into the business for upgrades, improve tech for efficiency, and maybe even expand and open up another store later down the track. But if we were to take 80%, that would only leave 20% available to go back into the business for growth. This is where companies with high payout ratios can get hurt, which results in inadequate cash flows for growth. This is where low dividend yield stocks could have potentially had the chance to shine, where the business can confidently look for expansion rather than paying the majority of their profits to shareholders and inadvertently tightening their cash flows for future growth. Thank you for watching. If you have enjoyed this video, please subscribe.